growing your business, growing your retirement savings, to then be a tax-free retirement income as well in the future.
Mm. I think
So
that's one thing, like, especially, I guess, when younger, even myself, kind of thinking, oh, super is just way down the track, don't need to think about it. But
it's like having another person in the household. So if you think about a self-managed super fund as another person, set up costs ranging from $1,500 to $5,000 to set up the fund.
hello, everyone, and welcome to another episode of Passive Income Doctor. Today, we have a special guest, Nadine. Um, Welcome to the show.
Thanks, Daniel. Good to
Um,
be here.
First of all, can you explain uh, who you work for and yeah, what you do day to day?
Yeah. So I'm a financial advisor. So I myself focus on goals-based planning and holistic advice. So day to day, I talk to my clients about what they want to achieve, and then we usually draft a plan together, and then over the years, tick off their goals together, which is very rewarding. So I work for a company called Blue Rock. Blue Rock itself has grown massively over the years. So started with 8 people back in 2008, and today has about 350 people. And the concept is to be a one-stop shop for busy professionals like doctors, lawyers, but also business owners as well.
Yeah. And I guess probably a good spot to put in a general disclaimer. So obviously, anything we talk about today is just kind of general thoughts, and yeah, you should speak to your own kind of personal advisor who has your unique situation, and yeah, views expressed of the individuals rather than any employers or anything like that. So I guess today we're going to talk about a few topics. I know a few requested topics from some of my doctor colleagues have been about self-managed super fund,
Mhm.
and also in regards to property as well, and also residential versus commercial property. I know there's a few kind of trends, a few kind of commercial buyers agents that have popped up recent years, and I know some of doctors have kind of moved into that space. So
Yeah.
let's start with self-managed super fund. So what is a SMSF, and why
Yes.
would someone consider it?
Yeah, so self-managed super fund, a bit of a mouthful. We usually just say SMSF. So that is a type of super fund. We typically see three major types, being industry super funds. So they're like your Aware Super, CBA Super, and then the second one being retail super funds, which are completely independent from any industries. And then your third one is self-managed super fund or SMSF. So I guess the main difference is SMSF gives you the most control, and also investment options, with the ability to invest in direct property, being a major point of difference there, which is something that you can't do in any other form of super funds.
And um, industry funds typically have a kind of lower percentage fees, although there's different options. I think ranges from 0.07, I think as low as up to about 0.6% or something like that. Um, is there a kind of minimum balance that, as a rough rule of thumb, that someone should reach before considering a self-managed super fund?
Yeah, so it really depends on the circumstance and what investment strategy the person would like to have. But generally, we like to see a minimum balance of around 300,000 to 400,000 before considering that structure. So yeah, to sort of expand on your point in terms of costs, typically industry super funds are the lowest costs, but the most limited investment options. And then retail super funds, slightly higher costs and slightly bigger investment options. And then self-managed super funds with the highest costs, but then also the most investment options. So interestingly, though, I just want to highlight this point. A lot of the costs for industry funds and retail funds are percentage based. So if you think about that, the bigger your balance gets, the higher the costs. Whereas some of the costs in a self-managed super fund are often fixed costs. So that portion of the cost doesn't necessarily grow with the balance as well. So we've seen some cases where people actually save money in terms of administration costs by moving from industry super funds to a self-managed super fund.
Yeah. And can you tell us, again, rough figures, what the cost would be associated with a self-managed super fund, firstly to set it up and then secondly for the ongoing management or compliance costs?
Yeah. So again, it depends on the structure or the complexity of the investment strategy within that fund itself. But we're seeing setup costs ranging from $1,500 to $5,000 to set up the funds. And then in terms of ongoing costs, we are seeing a range of $2,000 to about $4,000 a year. So if you think about that cost, that probably sounds high. Um, yeah, so self-managed super fund, we often say it's like having another person in the household. So if you think about a self-managed super fund as another person, that entity or self-managed super fund has to have its own bank account, just like a person. And then it has obligations as well to do tax returns and reporting compliance and things like that. So a lot of that ongoing cost would be outsourcing those obligations for a specialized SMSF accountant to help you look after those obligations.
Yeah. And so, yeah, I guess if we say kind of $2,000 ongoing costs and let's say 400K balance, yeah, that's roughly about 0.5% per
Yeah,
year, which, yeah, I guess would you could say is similar to say industry fund.
yeah.
Just on a side note, like um yourself or maybe some of your more senior or older colleagues, like how has the super changed over I was listening to one of the other podcasts, who's a financial planner as well, and they were saying how in the past retail funds was kind of all the rage and then kind of has slowly shifted favor or power to the industry funds, and then also self-managed super fund, kind of went out of favor. I can't remember 2015, 17 when the tightened the lending. What has been the trend for super over the last, let's say, I don't know, ten years or so?
Yeah, we're seeing a lot of improvements in terms of product offerings and costs in the retail space. So yeah, I think traditionally industry funds are the lowest in costs, but now the retail players are pretty competitive as well. So with technology, they're able to use technology and new platforms to be more effective in the way that they run the funds, which has given them advantage to push the costs down and compete with the industry players. In terms of self-managed super funds itself, I think it really goes back to the individual circumstance. So you mentioned a good point there around lending appetite. The four major banks have actually exited the market and they don't do lending to SMSFs anymore. But I think at the moment, there are probably about up to 10 trusted lenders that are playing in that space. Um, and I guess the one of the differences is they are also a lot more compliant, I guess, in the way that they assess your borrowing capacity within the fund. So I think in the past, it was just a letter from your accountant would be enough. Whereas now they would want to see pay slips to look at your super contribution history or previous super statements as well, if you are a business owner, to sort of show that you have that track record of being able to contribute to the super fund.
Mm. And this is just maybe speculating, but why do you think the big banks exited? And is there any talk of them coming back in, or do you
Oh,
know?
I'm not sure actually. Yeah, I wouldn't know, but yeah, I mean, the current market itself, I don't think I think the need for SMSF lending will always be there, because it is such a good opportunity, and when you deploy the strategy correctly, it can be a really powerful tool to grow your retirement savings. Um, yeah.
Yeah, and we'll talk about a case study about a successful self-managed super fund as well. Um, I'm just wondering, going on to about retail funds, is that kind of, I hear this term like wrap platforms. Is that right? Like, where basically is
Yes.
it kind of clients can kind of choose and pick their own investments rather than relying, because on the industry fund, you kind of, I mean, you have maybe a couple options, balance,
Yeah.
aggressive or growth. But is it these retail platforms you can kind of choose your own index funds or shares? Is that how it works or?
Yeah, exactly. So usually in industry funds, you get into a really big pool of investments. So you just become one of the other, millions of people that are in the fund. Whereas in a retail fund, some of them or most of them do have those options as well, because a lot of people just don't want to think about picking their own investments within super because they can't touch it anyway. So they do have those options where you get like a pre-mixed investment option, but then you can essentially complement those options if you want with specific stocks or ETFs and things like that.
Okay. And was it, I think Vanguard, is that right? Like, was
Yes.
entering the space, or I guess that's huge for big global American
Yeah.
player to enter the Australian market. Maybe they
Yeah.
see a future here.
I see potential.
Yeah. Um,
Yeah.
so with self-managed super fund, again, this is general. Some advisors or blogs that I read, they say, you should do self-managed super fund mainly for shares if someone is heavy in property as a way of diversification. Although a devil's advocate argument is that, with all these compliance costs and a little bit of a headache in setting up a self-managed super fund, the main advantage of it is kind of able to leverage and borrow to buy property. Do you have
Yeah.
any kind of general thoughts on that?
Yeah. So I think that's actually a common misconception that I see a lot when we talk to our clients. So a lot of people hear the word self-managed super fund and they just turned off by it because they would say, I don't want to be managing my own super fund. I couldn't care less about that. I can't touch the money anyway until I retire. Um, but a lot of the administrative burden, you can actually outsource that to a professional. So yeah, so there are specialized SMSF accountants out there that can help you with those things. So the self-managing part of um, that super fund is really just you having more control of the investment options. And then, sometimes if you have a rental property and you have to pay the water bill and things like that, there are just those transfers that you just need to do. But it doesn't have to be much more than that. Um, so that's one thing that we see a lot. And then, yeah, in terms of is it worth it? Is it not worth it setting up one? I think it comes back to the investment strategy for that person itself. Yeah, because I think that there are a few considerations there which we can touch on today, that I think are important before you set up a fund or, just follow the crowd, buying a property inside your super fund just because.
Mm. And do you have any clients that have both a self-managed super fund and then say an industry fund or?
Yeah, so it's probably not, definitely not the majority,
Yep.
but we do see that sometimes when the client has insurance policies in their either industry funds or retail funds that cannot be replaced. So often that could be a reason to maintain both. Another one could be a defined benefit. So, like police officers or people in the education sector often get two portions of super funds. So one's defined benefit, one's accumulation. So yeah, often we just leave for the defined benefit, and then we just manage them self-managed super fund as an addition to
Mm.
that.
Okay. And have you had anyone kind of do a self-managed super fund and then kind of like regret it and then go back to industry fund or anything like that?
I haven't personally come across that. But I've actually heard one where they had a self-managed super fund and then closed it. And then they decided to open it again to do crypto. Um, which wasn't our advice, by the way.
Yeah.
Um, but yeah, so yeah, I think it definitely happens, but I think if that's why I think it's important to, before you actually do the strategy, talk to an advisor, make sure that whatever strategy that is, you can actually sustain that for the long term or for the intended time frame, because it can be quite costly to switch
Yeah.
between the two.
Because I was thinking in that scenario, if someone closed it and then started a new one, is it using the same entity or I presume would have to be a new entity, right? Like you can't use the same paperwork and all that, I
Yeah,
presume.
yeah. You probably need to apply for a new one. Yeah,
Okay.
yeah. Go through the process again.
And with your clients that do self-managed super fund, like what percentage kind of do property and what percentage does kind of like, shares or managed funds? Is it the overwhelming majority for property or?
Yeah, I would say so. I would say 85 to 90%
Mm,
probably have self-managed super fund to have direct property,
yep.
uh, with the remaining 10, 15 to be sort of your more sophisticated types of clients, that would, yeah, have their own sort of specific investments that they want to invest in, within that structure.
And of those that do property, kind of what percent would you say does commercial and resi? Is it half half or has it changed
Mm,
over the years?
It's probably more, oh, it's probably more residential, but almost 50-50 residential
Yeah.
commercial. I think because at Blue Rock we do have a lot of business owner clients. So um a really cool thing that you can do within a self-managed super fund is, if you're a business owner, instead of renting a building as an example for your medical practice, instead of renting that and paying rent to a third party, you can, where appropriate, actually buy that building via your self-managed super funds. So then your business continues to pay rent, but instead of the rent going to a third party, it goes to your self-managed super funds. And that rental income is actually on top of any super contributions as well. So as you continue to grow the business, you grow the fund as well doing that. Um, and then if, let's just say, when you decide to retire, then the business gets passed down to the next generation. Um, so that rent continues. That rental income actually becomes tax-free when you retire. So, that can turn from growing your business, growing your retirement savings, to then be a tax-free retirement income as well in the future.
Mm. I think
So,
that's one thing, like, especially, I guess, when younger, even myself, kind of thinking, oh, super is just way down the track, don't need to think about it. But I guess if you do plan ahead and, once you can access your super, having that kind of tax-free, would make a, big difference. And I mean, one
mm,
thing is the legislation risk, the government could change their mind down the track, although, I think it would be a humongous change if the government then, I think the government always tends to play around the edges, maybe change the maximum balance and things like that. But to kind of make super not tax-free income during retirement would be, I think, quite brave and quite a huge thing.
yeah, yeah. I think that's one thing that legislations always change. But I think if we go back to the purpose of super is for self-funded retirees. So I think, hopefully the rules will always be sort of favored towards that. But, in the past, people can just contribute without any limit. So
Mhm.
people can I think the biggest super fund at Blue Rock is $100 million.
Wow.
Um, and that's a lot. So yeah, I guess the rules can change, but the purpose of super is for self-funded retirees. So I think there's always going to be benefits for people to do that.
Yeah. Okay. Should we talk about a case study about
Yeah.
yeah, which one do you want to start with?
So maybe we'll touch on the commercial property example because we just talked about that. Um, so one of our clients, and they've been clients of ours for a long time. So they're three business partners, and they set up their self-managed super funds probably about 10 to 15 years ago with about $1 million in the fund. So yeah, three business partners, and they bought a factory via the self-managed super fund. Um, so that was 10, 15 years ago. And then fast forward to now, they have four properties in their fund. That's worth about 6 million in total.
Oh, nice.
So yeah, obviously there's been growth over the long term. And I guess one important thing as well there is their business also has been growing, so they can sustain the cash flow within the fund and then hence buying those other properties as well. So now the three business partners are in their late 60s to 70s. So they are retiring. So now the next generation, which is their children, are continuing the business. So now essentially the rental income that the business is continuing to pay is their retirement income for the original three business partners. And then, yeah, which is, yeah, tax-free and funds the majority of their retirement.
Yeah. And these three business partners, so I assume they were quite close and had been in business for a long time. Because I guess
Yes.
I presume there would have been discussions or hopefully in the drawn up if one of them wanted to exit it, like what would the
Yes.
exit plans be? Is that right? Like,
Correct, correct. So yeah, so a self-managed super fund can have up to six members.
mm,
That can be anyone. So it can be family members, or it can just be friends or business partners. So in this example, they are family, the three of them. But we see other clients as well in business where they're, not blood related, and they're just purely business partners, and they have a joint super fund together. So in those cases, like you said, it may not necessarily be that they want to exit because there's a falling out or anything like that, but another example is that they are actually wanting to retire now. Um, so that they're actually in the health space. So they want to retire, and then they've grown the fund together over the journey, but now in retirement they have different goals now. So now we're actually in the process of separating their fund, so that they can have just their sort of tailored investment strategy for each of them.
Mm. And uh, what would the mechanics be of separating? Like, is it you have to close down, sell all the assets, close down the fund, or can you, um, is that kind of the easiest way? Because I presume if you change ownership, that would trigger, stamp duty,
Yeah.
capital gains tax, and things like that.
Yeah. Yeah. So that's, I guess, yeah, there is a level of complexity there. So I guess that, yeah, that would really depend on the circumstance. And I would strongly suggest talking to an advisor
Yes.
if anyone's in the situation. But yeah, as an example for them specifically, we are able to, because they're retired and they've satisfied that requirement,
Mm,
we can sell the assets without any tax implications before we split the fund. So
okay.
you can sell the assets, split the fund, or you can potentially in specie transfer some of the assets as well, which I think is a nightmare administration wise for the accountants. But yeah, so there are options and different implications depending on what you
Yeah.
want to.
And the $6 million, that's the valuation of the four properties, is that right?
Yes.
Or is that including some kind of cash sitting in there as
No,
well?
so that's just the property, and then on
Yep.
top of that, the four properties, and then on top of that, they do have cash and other more
Yeah.
liquid investments as well.
Okay. And I guess, yeah, over the 10, 15 years, I guess growing from that 1 million to 6 million, I guess some of that would be from, yeah, capital growth, but then I guess it'd also be
Mm,
from the individual super contributions as well. Is that right?
correct. Correct. Yeah. So for them to buy those properties initially, they would have taken debt. So over the years, with strong contributions, they are paying down the debt as well. So, yeah, yeah.
Yeah.
So that growth
Just
is, I guess.
curious, out of that 6 million worth, like how much of that is debt now, or is it completely debt free?
So I think it's completely debt free now.
Nice. Mm,
And then yeah, and I don't remember the
yeah,
initial debt.
yeah. And these four properties, like, did they end up doing all commercial or
Yeah, so three of them are commercial. So three of them are factories that they are still using for the business operation
yep,
that is
healthcare.
going.
Yeah, yep,
Um, and then one is residential.
yep. Okay. So I'm gonna guess just looking at that in terms of the income, so I guess tax free and yeah, all the outgoings would be paid presumably by the tenant. So assuming 6%,
Mm,
so that's 1%, six. It's about 360K, something like that.
yeah,
Kind of,
yeah.
and then yeah, divide by three. Um, hang on, I'm just going to use a calculator here because I don't want to get the numbers wrong. 6 million times 6%, 360. Yeah, okay. So yeah, about 120
Mm.
K, which is a comfortable retirement. Yeah. Um, awesome. And let's see. So we're talking about that. So I guess from that, talking to the clients, I assume they're quite happy that they set up the self-managed super fund all those years ago, and yeah, now they're enjoying the fruits of their
Yeah.
labor. Were there any kind of key lessons for themselves or for you as the planner in this case study? Any learnings from this one?
Yeah, I think this one is actually an interesting one because our accountants years and years ago actually had to convince them and sort of push them into making that decision. So I guess that's where you sort of see the value of what we do and why we love what we do is sort of talking about clients about potential strategies to maximize wealth, but then also hold their hands as well throughout the journey and give them that confidence. Because sometimes, it is a big commitment to sort of set up a fund and then get borrowing, buy property. So without proper help, that can be overwhelming. Um, but at the same time, you also don't want to jump the gun and just buy property and borrow money without really knowing what the implications would be, which sort of leads me to another case study example where a client came to us already having set up a self-managed super fund, and they've bought a property, a residential property worth about 900,000 in that fund. And then within the fund itself, there's only about $500 in cash. So that is nowhere enough to act as a cash buffer. So if you think about residential property and having a tenant, when you use it as an investment property, you do have the risk of losing the tenant. So, your property can be untenanted for a few months, or if there's sort of repairs and maintenance and things like that, you want to make sure that there's enough cash buffer in the cash account within the self-managed super fund itself. And then now, because there is not enough cash in the fund, they essentially have to top up um, that cash account from their personal cash account via super contributions. But the problem is their income. I think one of them lost their income. So now they're down to one income, and they also only have about, I think, 10 to 15,000 in their personal cash. The
Mm,
other problem is they're actually quite young as well. I think they're in their 40s. So any money that they put into super to sort of top up that cash account, they essentially can't touch until they're age 60. So that's a very difficult situation where you have a property, but you essentially can't sustain the cash flow within the fund, and you're having to take money out of your personal accounts to help the situation, but there isn't really any money there either. And then also you're basically foregoing the ability to use that cash as well.
mm,
So if you think about people usually within that age range would probably have kids going to school and things like that. So that's, a major need to be able to retain cash outside of super, to be able to fund things like that as well for kids and education. So that's a situation where you don't want to end up in. Um, yeah,
yeah, and that was actually the last question, talking about, what are the downside risks and disadvantages. Is one is, yeah, it sounds like perhaps they didn't get proper advice initially, or
yeah,
unfortunately sometimes, yeah, as you said, life changes, maybe loss of an income.
yeah.
And yeah, especially with residential property, it's a lower yield or cash flow than a commercial property. So often, yeah, you will need to have, super contributions, similar to, I guess, if you're buying the investment property in your personal name, and
Yeah.
especially if it was a capital city kind of lower yield, there will be some negative cash flow, and that
Mm.
leads us to negative gearing, which is also a topic for another day as well. Um,
Yeah.
so what, I guess, finishing up, what trends do you foresee for self-managed super fund in the near to medium future? Do you think the government might um, tighten it? Do you think banks will become more favorable or less favorable? Any thoughts?
Yeah. Yeah, I think super is always a sensitive topic when it comes to regulations and government, and they always sort of seem to want to make changes to sort of tighten that. But yeah, going back to my point earlier, I think it's important to also think about the main purpose of super. So yeah, and at the end of the day, I think you can only work within what you know at the time, but not forgetting that any sort of scenario or any strategy that you implement, I think you need to be comfortable with sort of changes that might happen in the future. So as an example, interest rates. So we've seen the interest rate double and tripled in the last few years. So, if this was in 2020 and we're thinking about doing this strategy, we would actually use a higher sort of long-term interest rates to do that calculation
Mm.
for the strategy. So yeah, just sort of thinking about things like that and making sure if interest rate increases or they're tighter in terms of super contributions and things like that, that you are you have some sort of buffer there in your strategy.
Yeah. Well, thanks, Nadine, for coming on today and talking about this hot topic. Definitely keen to have you on again. There's so many other topics we can talk about. Wills,
Yeah.
estate planning, other investment vehicles and things like that. How
Yeah.
can people reach out to you or the company and kind of learn more about what you guys do?
Yeah, so you can look up Blue Rock on on the internet, and there's a landing page on our website for you to get in contact with any sort of advisor that may be relevant to you. And then we do release articles as well from time to time for specifically health professionals. So if you look on our website as well, you can enjoy those resources for free.
Yeah. So thank you to our listeners for joining us for another episode of Passive Income Doctor. Feel free to email any topics that, or even questions, and Q&A is something I've have in mind as well. And until next time, see you on the next episode.